Can the best fit for your portfolio be a pair of comfy jeans? Fasten your seatbelts, folks. This is going to be a good one. The Canadian clothing sector is like a fashionista's dream closet, full of diverse and trendy brands that range from luxurious to wallet-friendly. With over a century of history, the industry has faced its fair share of challenges, but it continues to adapt and stay pretty well, stylish. From well-established players and up-and-comers, the Canadian clothing scene is constantly evolving to meet the changing demands of fashion-forward consumers. Despite competition from, everywhere, and rising production costs, the sector remains a vital player in the Canadian fashion landscape. In today's video, we are going to be focusing on Aritzia, which is one of the more well-known of these Canadian brands. Before we do, you get an opportunity to join the conversation. Let us know in the comments your favorite Canadian brand. Your participation is, of course, well appreciated. Don't forget to like and subscribe to stay up to date on future content, and thank you for that click. Aritzia is a fashion brand that was founded back in Vancouver in 1984. Initially, the company focused on selling women's clothing that was imported from Europe and, of course, the United States. Over time, though, Aritzia began to design and manufacture their own clothing lines with a focus on modern minimalistic designs and high-quality materials. Throughout the 1990s and the 2000s, Aritzia expanded its retail presence across Canada and began to establish a reputation for its trendy high-end clothing. By 2012, the company opened its first stores in the United States. Actually, I believe it was Los Angeles and New York. Today, Aritzia has over 100 stores right across North America, and they have a very strong online presence, offering quite a range of clothing and accessories for women. The company is known for its sleek, sophisticated aesthetic and commitment to sustainable and ethical manufacturing practices. That sounds great, and from the outside, they look very interesting. However, I never trust the wrapper, as the math always knows the real story. When we hit our surface data, they've got a market cap of $4.75 billion. They come in with a slightly volatile beta of 1.57. Their earnings per share comes in at 1.54, and their price to earnings ratio, that came in at 27.96. Now that is a little bit higher than the average, which is 13.7 for similar type stores. Their price to book ratio also comes in at 7.40, a little high, but I can still live with it. When it comes to revenue, their revenue is $2.00 billion, with earnings on that of $184.48 million. Now those earnings, they are projected to grow by 25.26% per year, which is great. Now, when we look at their free cash flow though, that's not so great. It comes in at negative $39.62 million. I always hate to see a negative free cash flow. However, when we do look at their return on equity, that comes in at a very healthy 32.46%. This is a good number, and this absolutely makes me think about nothing when I look at that free cash flow. A good ROE like this also makes me think they're going to have a pretty good debt situation, but we'll get to that in a bit. When it comes to their fair value, they are actually considered undervalued by a whole whopping 25.26%. That's not a bad thing. That definitely means that there is room to grow. All right, let's get to the return side of this whole equation. Now, Aritzia, they do not have a dividend, so we don't have to worry about that. But let's switch over to growth. Their 3-year growth, their share price rose from $22.13 to $42.95. That is a return on investment of 94.08%. That's fantastic. That's a really, really solid 3-year return. When we hit the bear market in 2022, when we get to 2022, we do see a little reaction to the bear market. They fell from $53.02 to $47.35. That is a ROI of of negative 10.69%. That is actually still better than the TSX, which had a negative 17% performance in that same period. So far in 2023, when everybody else has done a little bit better, well, a little bit better up until the last few days, we have a price that went from 47.35 and it fell further to 42.95. That's another negative 9.29% return on investment. So they've done great through most of the pandemic, but the bear market's got them a little bit, and they're not off to the great start I would have loved to have seen this year when the market began to flip a bit. Growth is kind of a mixed bag. I do like the overall growth, though, for the 3-year and the overall trend that company has been taking. But we'll talk more about that when we get to the final verdict. All right, let's switch over to debt. I love that debt. So we mentioned earlier they had that really nice ROE. Well, what did I say then? I said it probably meant their debt situation looked pretty good. And, well, they've got a total debt of 0. So, yeah, their debt situation is going to be looking really well. So their total debt is 0. Their total equity is $639.48 million. That, of course, means their debt to equity ratio is also 0. Now, they do have in cash and equivalents $131.90 million. So that could definitely help with that, in regards to the whole negative free cash flow aspect. Let's look at their short-term assets. They have $704.27 million, and liabilities, they have $515.17 million. Perfect. Long-term, their assets come in at $1.04 billion, and their liabilities come in at $587.98 million. That's also fantastic. And of course, the fact that their short-term assets of $704 million covers that long-term liability of $587 million is a huge plus with this company. So debt-wise, I love what I see. So what is the final verdict? Aritzia had an amazing run through the pandemic, and a good amount of that is people being locked in their homes starting to buy a lot of online products. And where Aritzia has a great online presence, they certainly capitalized on this. In addition to that pandemic growth, this is a company with no debt and very deep pockets. They may have reported a negative free cash flow, but their earnings forecast to go up significantly. You have to give them a pass on that. 2023 is the blotch on their growth, and that is always concerning until you back out. They overall are still on an uptrend, and concerning, yes, but worrying, not yet. I do believe long-term, this is a fantastic stock for exposure to this sector, and growth is something I would expect to continue seeing. This is definitely a solid long-term pick in my opinion. Keep the learning going. Watch my video on natural resources linked on the left, or test YouTube's recommendation by checking out the video on the right. Your choice will decide the winner. See you in the next video.